Okay, now Chapter 8, Reporting and Analyzing on Accounts Receivable. The study objectives here: identify the different types of receivables, explain how the accounts receivable are recognized in the records of a business, the accounts, describe the methods used to account for bad debts, and also we're going to introduce just notes receivable, a little bit of notes receivable. The rest you can go over if you want with the PowerPoints, but this is all we're going to cover in Chapter 8. Okay, types of receivables. There's the amounts owned by customers that result from the sale of goods or services. Those are called accounts receivable. Those are the ones that you are familiar with. Now, sometimes a company has money that is owing to them for a long period of time, and somebody says, okay, I'll write you a note, says, I promise to pay you back in 6 months at such and such plus such and such an interest rate. That's called notes receivable. That is something that's going to come to me, but it's a note, a financial note. If you're taking finance, you will come across notes. There are other non-trade kind of receivables that doesn't refund, like income tax refunds and things like that, but that doesn't really concern us at this point. Okay. We're looking at the accounts receivable. There are two issues here. One is recognizing when we have accounts receivable. That is, when does an accounts receivable arise? Of course, it arrives when we provide the service or sell the product. The second thing is, what value is that accounts receivable? Now you may think, well, okay, that's a silly question. What value? I know what the guy owes me. Yeah, but if you have a whole bunch of people owing you money, it's only human nature that not everybody's going to be able to pay you. So you have to make an estimate of exactly what is the value of the accounts receivable. So recognizing accounts receivable, we recognize them when in a service organization when we provide the service. If we are a merchandiser, we recognize revenue or recognize accounts receivable at the time we sold the merchandise on account to the customer. Illustration, here we have Gordash Company, 2012, sells merchandise to Polo Company, 1,000, terms 210, net 30. You remember what the terms stand for. Prepare the journal entry to record this transaction. Wow, okay, we recognize revenue because the merchandise had been sold, but we're not getting cash, so it's debit accounts receivable. Credit, sales revenue. So that's on July 1st when we make the sale. July 5th, he returns the merchandise worth 100. Well, you know all this from Chapter 5. We don't debit sales. We set up a account called Sales Returns and Allowances and give it a debit balance. So we debit Sales Returns and Allowance 100, and we credit accounts receivable because the guy doesn't owe us that anymore. So we reduce the accounts receivable. Then we receive payment. Now we get the cash. The guy is within the discount period, so he's going to take a discount, and so on. So the cash we get is $882. He takes a sales discount. We debit sales discounts, the 2% of the $900 that's owed us, and we credit accounts receivable because he's paid us. So these are all familiar to you. They were in Chapter 5 journal entries. All right, now when we talk about accounts receivable, we talk about, okay, it's a current asset, and we have to show it at its realizable value. That is, what do we expect? We don't expect, it's not realistic to expect to collect 100% of what's owing to you. Generally, you're going to collect maybe 98% of it or 97%, something, but something will happen. So you see sales on account arise because accounts not being collected. And when we don't have, when they don't collect, that's an expense of doing business. By giving credit sales to customers, we can get more sales. We know that. But we run the risk of not collecting all the money that is owed to us. And so therefore, we make an estimate as to how much we're not going to collect, and we recognize that as bad debts. Now there's two ways of recording this in our records. There's the direct write-off way. We don't do that. X that out. No way. The only way you do this is called the allowance method, because it's better for matching the expense against the sale. It allows you to state in the balance sheet what your net realizable value is going to be, and it's required by generally accepted accounting principles. Over here, the direct write-off is no matching. It's not acceptable for financial reporting. So all companies should be doing the allowance method, and that is what we are going to talk about. All right, so now we have a new account. It's called the allowance for doubtful accounts. Doubtful accounts are accounts that we think we're not going to collect. And what we have here is accounts receivable of 500. We now say, okay, of that 500, we're probably not going to collect 25. So we set up a contra asset account. The asset is accounts receivable. It has a debit balance of 500. The contra asset account is the allowance for doubtful accounts, and it has a credit balance of 2,500. And in this way, we can show it on the balance sheet. And this is how we do it. We have current assets cash. We have accounts receivable, 500, less the allowance for doubtful accounts, 25, and we carry 475. So you see we're showing the readers that the accounts receivable that we made in sales on credit was 500, but we don't expect to collect all of that. We expect to collect 475. Sometimes on balance sheets you see it this way: accounts receivable net of a 25 allowance for doubtful accounts. Well, that tells you that it's 475. Net 25 means 25 has been subtracted from obviously 500 to give us 475. So that's how we show it on the balance sheet. We show it as a accounts receivable, current asset, less the allowance for doubtful accounts. So that's a new account called the allowance for doubtful accounts. It's a balance sheet account. We also have another new account which is called bad debts expense, and that's an expense account. So let's go on and take a look at an example here. We have a credit sale, 100, debit accounts receivable, credit sales. Okay, so it goes here, accounts receivable, credit sales revenue. We collect 333 on account. So the people owe us 600 here, 500 plus 100. We're collecting 333, so it's debit cash. Our cash goes up, accounts receivable goes down. Now, of the amount left, 267 in accounts receivable, we figure we're not going to get 15 of that. So we make a journal entry. Debit bad debts expense and credit the allowance for doubtful accounts. And it goes over here. So now we've increased the allowance from, it was 267, we had 25 against that, we added it by 15. So we now say we have accounts receivable of 267 and we expect that we will not collect 40. All right, now let's say somebody comes along and we find out that they went bankrupt. Well, okay, we're going to write off that account. Write off means take him out of our records, take him out of accounts receivable because he's gone bankrupt, he's not going to pay us. So let's take him out of the accounts receivable and we charge the allowance. So the debit is the allowance for doubtful accounts, 10, and credit accounts receivable. So you see, we take it out. It doesn't change anything here. This goes down by 10 and this goes down by 10. So we still have the same net amount, if you understand what I'm saying. All right, and then we show it on the balance sheet. Accounts receivable, net of 30 allowance for doubtful accounts, 227. So that's how we do the journal entry. The next thing is that you have to know is, how did we come up with that estimate of the bad debts? It's an estimate of the accounts that we're not going to collect. And when we figure out the estimate, we debit bad debts expense and we credit the allowance. Okay, so when we have it write off, we debit the doubtful accounts and we credit the accounts receivable. Now, how did I come up with that estimate? Well, here's an example. Hampson Furniture has credit sales of $1,200,000, of which $200,000 remains uncollected. The credit manager estimates that $12,000 of that $200,000 will not be collected. So the bad debts expense $12,000, and the allowance for doubtful accounts, $12,000. All right. So we would show it then as accounts receivable less the allowance. We expect to collect of the $200,000 only $188,000. Regarding the write-off of an uncollectible account, the vice president of this company then says, okay, somebody's gone under, let's authorize, I telling you to take 500 out of the accounts receivable. Well, we take it out of the accounts receivable, we charge the allowance for doubtful accounts. So we debit the allowance for doubtful accounts and we credit the accounts receivable. So the accounts receivable will go down 500. It's now 1955, 199,500. And the allowance for doubtful account will go down by 500. Notice before it was 12,000 and 200. So we still have an equal balance between these two. All right. Now, let's say we were wrong about that guy for 500. He does come and pay us. Well, we put him back in the accounts receivable, and we put him back in the allowance for doubtful accounts. Then we recognize he pays us, and we debit cash and credit accounts receivable. Now, that's the way the net cash realizable value is the difference between the accounts receivable and the allowance for doubtful accounts. How do we come up with that estimate? We do a percentage of accounts receivable. This is called the aging of accounts receivable. So you see, we take everybody we had in accounts receivable. We take how much they owe us. They all owe us $39,600. Now we look at this guy, Ardat. He owes us $600. Not yet due because we gave him $210 net 30. He's past the 30 days, okay? So that is past. He also owes us something that he hasn't paid us for 3 months, and something even longer than that, 4 months. This guy, Coraz, he owes us $300, but it's not yet due. It's not even 30 days, net 30. He may give us a discount, we don't know. This guy, Carl, he's owed us for more than a month. He's past the 30 days. He's into the 2 months. This guy down here, well, look at this guy. He owes us $600, but it's been a long time that he's ever paid us that $600. So you see, the longer it's been since the sale, then the more likely it is we're not going to collect it. It only makes sense. If somebody's owed us money for 4 months, the odds of him paying are greater than if somebody owes us money only for 30 days. So you see, based on past experience, we say, okay, 2% of this will probably not be collected. 4% of this will not be. 10%, 20%, and 40%. So we take 40% of 1,900, which is 760. We take 20% of 2,000, which is 400. 10% of 3,000, which is 300. 4% of 5,700, which is 228. And 2% of 27,000, and we add these guys up, and we say, okay, we expect of the 39,600 that is owed to us, we expect we're not going to collect around 2,228. All right, but what they're saying now, this is called aging of accounts receivable. They're saying set the allowance. This is important. Set the allowance for doubtful accounts at 2,228. Well, in order to set the allowance, we have to look at how much is in there. Now, last year we had set up the allowance for doubtful accounts for I don't know how much. And every time everybody went under, we wrote it off, we debited the allowance. At the end of the year, we have 528 still in the allowance for doubtful accounts. We did the aging of accounts receivable here, and we said, okay, we expect now we're not going to get 2,228. Well, we don't make the journal entry to 2,228 because we're saying set the allowance. It should be, the allowance for doubtful accounts should be 2,228. There's already 528 in there. So in order to bring it up to 2,228, I must make the journal entry debiting bad debts expense 1,700 and crediting the allowance 1,700. so that when I post this allowance, my allowance now is $2,228, and I'm recognizing bad debts expense of $1,700. Now, obviously, last year I recognized bad debts expense, but it was too much because I still had a credit balance of $528. So this is the only way in which we journalized the adjustments for the allowance for doubtful accounts. Thank you. That's all, folks.